Hi there, this is Bill with Smart Trades, and it's October 5th, Tuesday around 4:45 p.m. Pacific time. I've been asked to do some longer term charts, and I'm happy to oblige that request. One of the things that I've been looking at lately is the CRB index, going back to about the mid 1450s. And one of the things that comes to mind when I look at this chart is the depth of the corrections, if you will, or the bear markets. And this is basis the CRB again, not the actual stock market. Nonetheless, I think it's a pretty good surrogate for the long-term market. And the point I would make here is that what I see is in Elliott terminology is a series of 1-2s, 1, 2, and then here's the 1920s and the 1930 depression. Also what I think is a 1-2, and indeed here we are into the 70s, and I think actually this best counts as yet another 1-2, and then 3, 4, 5. We should have a big sideways correction, assuming that this count is correct, and a series of higher highs and relatively flat corrections, assuming that we alternate as Elliott suggests that we should. Now again, here we catch up to more modern times, well, sort of. This is again the late 1920s peak, the 1930s depression, again a 1-2. Here's that second 1-2 in this sequence. And the implication of this is that we're going to see relatively flat and multiple fourth wave corrections in the coming years and even decades, perhaps out the next several hundred years. You know, obviously this is a bit of a stretch, but bear with me, and we'll take it one step at a time, so to speak. At any rate, one of the likely scenarios for a fourth wave is that it's a triangle. I count this possibly as only A of a very large triangle, which may yet stretch out another 6, 8, 10 years or more before we actually resume the long-term bull market. This pattern could also be a flat. One suggestion is that the flat is already complete. I tend to think with the huge debt overhanging the market that that's not the case, but from a purely technical point of view, it's possible. Another reason that I suggest that it's probably not a flat is you can actually possibly count this wave 2 as a flat. And again, Elliott's rule of alternation suggests that we need something different. We need a triangle. Could be an expanding triangle, could be a contracting triangle, but likely we need a triangle type pattern here to form a sideways fourth wave in the coming years. Zooming in a bit, again, here's the decline, which I'm counting as a completed A wave, and from there, obviously, we should go up in a B wave. Now, these projections are not in scale in respect to time. I've compressed them a bit so we can fit them on the chart, but the basic idea is that we completed A on the March 2009 low. From there, we have an ABC rally, which should take us up into the top of the triangle, and perhaps 1,300, 1,400 on the S&P. But first, I believe that we need to correct the rally from the 2009 low to the April 2010 peak. I think it best counts as A down, and that we're working on B and perhaps getting close to finishing B now. The depth of the C wave, C of B, if you will, is really up for argument. The most likely scenario is that C will be equal to A. That would take us down to approximately 940 on the S&P, and then again, I think we're probably going to bounce from there and have a substantial rally. That said, as always, we'll take it one step at a time, and at this point, B hasn't even definitively peaked, so and indeed it could go higher, as noted in the earlier video today. And also a little bit of evidence to a possible peak here is, and I've talked about this before, but I managed to put these charts one over the other. This lower chart is the Dow Jones Industrials daily chart from 1987 to just after the secondary peak there. And I would bring your attention to this basic pattern, which I believe that was that peak is October 2nd that year. Now, up above here we have the Dow Jones weekly, and we have two equal legs up. That would terminate right around the 11,030 mark, basis the Dow, and sometime this week, you'd have equal legs up both in terms of price and time. Again, around 11,035 or so. Notice too that we have this doji right before the peak, right at the peak in 87. It's certainly possible we could yet form a very similar pattern, but we have to wait till weekend, obviously, to see how this bar on the weekly chart closes. And finally, same chart looking at the S&P, and again our target was 1157 for two equal legs up, but keep in mind that in terms of time, October 6th or October 7th will be equality in terms of time for these two legs up off of the July low. And again, at this point, at 1160, 1161, 1162, we're about 0.5% above a perfect A equals C. And again, the A equals C is a guideline. The idea is not that we're going to hit that, on the nose exactly, but again, you can see the similarity to the 1987 pattern. 87 was an irregular ABC. We obviously have more of a zigzag. I think that zigzag actually is a more bullish pattern leading into the C wave, but we shall see. The bottom line is we're very close to that equality for these two legs up. We're mirroring to some extent the seasonality and the pattern of the 1987 play. So let's see how it goes. Again, we'll wait until we actually see a turn, but I think it's worth being wary of this market right here because I'm starting to see also a little bit of exuberance, shall we say, in terms of the bullish opinion out there. Anyway, hope you're having a good one. Thanks so much for watching. Talk to you later.